Hey, shout out to the one and only PPC Ian and his conversation with Greg that he had on the channel. Link in the description below if you want to check that out. I recommend that you do so. And it really got me thinking differently about an asset class that I had turned a blind eye towards, which are BDCs. Hey, what's up? I'm Russ, and this is my channel, Dapper Dividends, where we're all about thinking beyond the dividend and generating passive income without having to sell our stocks. So if that sounds like something you're interested in, rub the magic sub button below so we can stay in touch. So in a nutshell, this whole thought process is basically not being overly concerned with share price appreciation or dividend growth, but with that steady eddy cash flow that we can use to invest in other opportunities or even buy more of those same assets. And in this case, the two BDCs that I just did invest in, buy more of them, get that snowball rolling, and they can pay us even more cash flow. So BDC stands for Business Development Company, which was created by Congress in 1980, and they help other companies grow and become more successful by providing advice and financial support when they cannot access traditional funding from banks. So BDCs are like big helpers to other companies, and many dividend investors, including myself, had been turned off by the really high yields because we usually think the higher the yield, the higher the risk. But as Stephen Bavaria pointed out in the Income Factory, this is by design. BDCs pay higher yields because they invest in companies that are considered to be riskier than other companies. This means there is a chance that the BDC could lose money if the companies they invest in don't do well. So to make up for this added risk, BDCs offer higher yields to investors. This way, they are more likely to want to invest in the BDC even though there is some risk involved. This is why it's vital for the BDCs to be careful about what companies they choose to work with and to make sure that they are making good decisions. Now, it's difficult to say what BDCs are best because every investor is different, so it's going to be dependent on that investor and their investing style and risk tolerance. So for example, some BDCs might be better for people who want to make a lot of money, while others might be better for people who want to be safe and not risk losing as much of their money. And it's important for people to think about what they want and then find the BDCs that are best for them. Now, one of the biggest distinctions with BDCs is if they are internally or externally managed. Where internally managed BDCs are run by the employees of the company, and externally managed BDCs are run by, you guessed it, a separate company. An internally managed BDC might be better for some people because the people who work at the BDC have a lot of knowledge and experience about the companies they invest in, while an externally managed BDC might be better for some people because the separate company that manages it might have more expertise or resources. An internally managed BDC might be better for some people because the people who work at the BDC have a lot of knowledge and experience about the companies they invest in, while an externally managed BDC might be better for some people because the separate company that manages it might have more expertise or resources. But externally managed BDCs have higher cost structures that eat into the company's profits and reduce the amount of money that's available for distribution to the shareholders because they don't actually work for the company. As noted in this excellent and free BDC investing guide by Simply Safe Dividends, which is linked below, two main concerns with externally managed BDCs are management does not have to disclose exactly how they're being paid, and as they point out, the CEO of Prospect Capital, ticker PSEC, reportedly made as much as $100 million annually, over 30% of total revenue some years. And second is a conflict of interest. Management can guarantee itself a higher payday as long as gross assets are growing, like selling new shares or taking on extra debt to grow its fees. So externally managed BDCs can be run kind of like a hedge fund where they're making management wealthy first and then the investor second. The word vampire comes to mind. But internally managed BDCs like Main Street Capital, ticker MAIN, generally have lower costs as well as compensation incentives better aligned with the shareholders because they are usually based on growth in net asset value or NAV per share. So without getting too deep into the weeds, and we're going to take a really high level look at two BDCs that I did just invest in. One is internally managed and one is externally managed. So first up is Ares Capital, ticker ARCC, which was created in 2004 by Ares Management Corp, ticker ARES, for the purposes of corporate lending activities, and today is the largest US BDC with 458 portfolio companies. Now, Ares Management looks to be a great external manager, as this is an advantage because of their almost $300 billion of assets under management, which operates worldwide across credit, private equity, and real estate. So as I dug into it, what I really liked about Ares Capital was that they invest in less cyclical, service-oriented industries for cash flow. Now, if you didn't know, BDCs are required by law to pay out 90% of their net income in dividends. So check this out. Ares' net investment income, which is what funds the dividend, is currently at an average of $1.51 a share for the 9 months ended on September 30th, 2022. And their total distribution to shareholders for the period is $1.36, which includes 9 cents of special dividends. So that puts it right smack dab at 90% payout ratio on the nose. So management is doing what they're supposed to be doing here. And look at this chart where they've been paying those 3-cent special dividends ever since the Fed started raising rates in January, which has been quite the boon for ARCC, as 73% of their interest is floating rate. It floats up and down with interest rates, so when those rates are going up, lenders like ARCC are going to make more money. So, but what about when those rates eventually start coming down? Could that affect companies like Ares? And the answer is yes, as management acknowledged in their last earnings call. But they said that they're confident that they'll be able to sustain the dividend because, as they pointed out, they've been banking excess taxable income away, which is called spillover, and that can be used to sustain the dividend. And ARCC currently has $1.36 of spillover per share, as you can see here. So think of that as like a rainy day fund. Now, aside from Ivy Hill, which is also owned by the parent Ares Management, and Senior Direct Lending Program, which is a joint venture between Ares Capital Corporation and Varagon Capital Partners, no individual company makes up more than 1.5% of the portfolio, and no industry is over 23%, with software being the biggest slice of that pie. So this obviously helps insulate them from any single failing company or turbulence in a sector. And almost 50% of the portfolio are first lien senior secured loans, which means they're first in line to seize collateral in the event of a default. And they also have an investment grade BBB- credit rating because of their low leverage, which I think is a big plus. And some of the companies that they've invested in are surgical device company ConMed, audio platform SoundCloud, conversational AI platform MindMeld, and cloud computing company Faction. Now, Ares has never missed a dividend payment since they started paying that in 2004, but they did cut it 17% during the 2009 Great Financial Crisis. Take a quick peek right here with Simply Safe Dividends. They get a borderline safe dividend safety score of 59, right on the cusp of being considered safe from them. Current yield as of this recording, 10.29%. And they did grow that dividend 12% in October of 2022, and they are a large cap company. So again, you can see they started paying that in 2004. They did have that cut during the GFC. 1% 10-year CAGR, but again, this is something I'm wrapping my head around, and it took a minute, but this is by design. Currently paying $1.92 per share every year, and you can see that big jump in dividend payment from 43 cents to 48, plus all the special payments all this year, the special payouts since the Fed started raising those rates. Their dividend yield currently 14% above the 5-year average. PE is below the 5-year average. And again, see, they don't move much. Their 52-week price range, $16 to $22.58. They're currently at $18.66. And just a couple financials to look at. Free cash flow payout ratio isn't going to work for BDCs. So this is essentially their distributable net investment income, or DNII, which is also the earnings payout ratio. So we like to see that below 90%-ish. Simply Safe wants to see below 95, and currently they've ticked up a little bit, but they were at 86%, so they're well under that. A little bit of sales growth coming down, still 15%. The shares outstanding, though, don't be worried about this, because BDCs, this is how they're going to make their money, to invest and to make more loans and to grow the business and eventually grow total sales, as you can see here on the right, which is going up and to the right. So this is definitely how it is supposed to be done. And a little bit of a bugaboo, their net debt, 55%. So hopefully that can start to revert back to the mean of the mid-40s. This is BDCinvestor.com. A little bit of a sanity check here to see what you're investing on. I want to focus on the current price to net asset value. This is what I look at as either the discount or the premium. So we see here it's 1.01, meaning that there's a 1% premium on the price. So paying net asset value is just going to show the confidence of investors, and the more that they pay, the more it shows that the market, that investors are confident in those companies. So we want to see at least 1.0 or above. And as far as intrinsic valuation here at Alpha Spread, for the base case, they give $26.51, making it about 30% undervalued. And the worst case scenario is $20.03. So it is still 7% undervalued. You can also look at that as like a 7% margin of safety on the worst case scenario. And this is really cool to see. Looking at ownership, there has been nothing but net buys from the insiders. So we want to see the company, the people on the inside buying their shares, and they certainly are buying lots of shares every period here that's covered. So that gives me a really good feeling about the management being confident in the direction of the company. So Ares is definitely well run from what we've seen from the very high level view of the company. And a lot of different investors think that they might be a little bit riskier than another company that is internally managed, that I did also just begin a position in, which is Main Street Capital, ticker MAIN, which was founded in Houston, Texas in 1997. They have a portfolio of 195 companies and over $6 billion of investment capital under management. And they typically invest in lower middle market businesses that have an annual revenue between $10 million and $150 million. And right off the bat, impressively, Maine has never decreased its dividend, which was first paid way back in 2007. Their largest total individual portfolio company investment represents 3.3% of total investment income, and no industry accounts for more than 8% of their investment pie. And the majority of their portfolio investments represent less than 1% of Maine's income and assets. And a few of the companies Maine had invested in are SaaS company Volusion, crypto tax platform Zen Ledger, B2B e-commerce platform Zillion, and Palmetto Clean Technology. And almost 85% at cost and 76% at fair value of the portfolio are first lien debt, which again, this means that they're first in line to seize collateral in the event of a default. Like Ares Capital, they also have an investment grade BBB- credit rating because of their conservative structure. And remember when we talked about internally managed versus externally managed? Well, check this out. As of this recording, Maine has an operating expense to assets ratio of 1.4% and targets to be under 2%, which is the lowest in the industry and is great for shareholders as there's more money to invest back into the business. And again, while I understand that the rising rates are great for BDCs, I loved seeing that Maine's distributable net investment income, remember that's what they pay the dividends out of, per share exceeded their regular monthly dividends by 36%. And because of their strong performance as of late, they have paid 5 consecutive quarters of supplemental dividends, and management has expectations of a 6th supplemental dividend in Q1 of 2023. All right, here comes Maine on Simply Safe Dividends, Main Street Capital. Safety score of 62 safe. Not as quite high of a yield, but that's okay. 7.33%. This is Altria levels up there. 2.3% slow dividend growth in November of 2022. They're a $2.94 billion mid-cap company. Now, that dividend was stagnant a little bit during the recession, but it was still paid. They've never missed a payment. 5% CAGR the last 10 years. For a BDC, looks to be really solid in my opinion. Paying $2.70 every year, but they do pay monthly, so keep that in mind. They are a monthly paying dividend stock. Their dividend yield is 20% above the 5-year average, and that PE is pretty significantly below their 5-year average. And these BDCs, I'm telling you, they don't move that much in share price. 52-week range, $32 to $45, currently at $36.86. And this really is what drove it home, was that earnings payout ratio. Remember, the DNII, the distributable net investment income, has been trending down, and it's usually hanging out around the mid-90s, low 90s, but we're all the way down to predicted 75% for the next 12 months and currently 84% the last 12 months. Their sales, 28%, come down just a little bit. And when we look at their shares outstanding, again, much like Ares, these are the well-run companies. They're not just diluting shareholders and selling more shares and making offerings to bring in more money to pay management. So they're putting that right around investing in the business to grow those total sales. So we'd like to see a little hiccup there in 2020, understandable, going up and to the right. And their net debt, about 50%, so nothing crazy, although it has been ticking up pretty consistently since 2017. And we'll see if they can start to pay some of that down with this extra money they got coming in the door. And get that back to the low 40% range. And now again, remember BDC Investor, where we're looking at the current price to the net asset value. Check that out, 42% premium. 1.42 times you're paying over the net asset value of everything that is in their portfolio. So that means the market investors are very comfortable. This is a company that's in demand. So this is a really good fail-safe from what I've learned to check. I've seen some BDCs that are at like 0.70%. So you got a 30% discount going on because the market is not very sure. Well, Maine is about as good as they come in the world, in the land of BDCs. Currently a 42% premium on those shares. You're paying up for quality. And on alpha spread, here comes Main Street Capital with their intrinsic valuation of $42.44, which is about 13% undervalued as of the recording of this video. And their worst case, $35.33, meaning they're about 4% overvalued. But as I've been telling you, these are just guesstimations. These are not approximations. All that an intrinsic value is almost akin to knowing somebody needs to lose weight without knowing exactly how much they weigh. So this is just more of like a ballpark figure. And unlike Ares, they've had a little bit of insider selling. We see the CEO, Dwayne Hyzak, sold in March of 2022. So we'd like to see them buying a little bit more, but this is obviously not a deal breaker. And we always know there's a million reasons that anyone could sell a stock, but there's only one reason you're going to buy, and that's because you think the share price is going to go up. And comparing the total return, which is basically all the income and the share price returns for Maine, ARCC, and the S&P 500 from January 1st, 2008, we see that Maine is the clear winner with a 915% return, ARC 597%, and the S&P has had a total return of 182%. So I feel that I have a decent grasp on BDCs. And again, I would not take anything I'm saying as gospel. I'm just sharing some things I've learned with you and what I've been doing on my journey that I've now become a BDC investor. It's not going to be a big portion. I have these in the self-directed IRA portfolio, which is obviously tax advantage, but I'm thinking about putting some Maine and some ARCC in the taxable account because that is money that I'm going to be able to use without paying a penalty on. So that's something I'm still chewing over. Follow the channel and you'll get to see what goes on with that. But overall, I just have no real expectations for share price appreciation or really high dividend growth like with some of the dividend growth companies. But that's okay because I'm expecting those two things to kind of remain stagnant, but have that really steady eddy cash flow and income where I can use that to invest in other opportunities that present themselves, or I can use that to buy more of Maine or ARCC. I'd really love to know your thoughts on BDCs and if you invest in them, which are your favorite BDCs? Do you not like them? Please share in the comments below with the rest of the community. We'd all love to know. And check this out. My book you can get for free, Brief Thoughts on Life, Love, and Investing. Just thoughts I wrote for my kids a few years ago. The link for that is in the description below. If you were helped at any point, I'd love you to give the thumbs up again. And did you know that you can invest? Yes, you can own gentlemen's clubs and a famous horse racetrack. Well, if you'd like to find out 4 dividend companies you probably didn't even know existed, let alone paid a dividend, click the little box here next to my head. And if you do that, I'll tell you all about them and talk to you there.